Hi, I'm Mike Kelley. I'm a loan officer for Western AgCredit, and I'm located in our Tremonton office. I've been in ag lending for approximately 4.5 years and enjoy what I do. Today's purpose in this Borrowing Basics course is to discuss some of the items that we as loan officers look at when analyzing a credit request. I'm going to give a brief overview of what we look at, and the following presentations will go into more depth. Western AgCredit and most lenders use some version of the 5 C's of credit when evaluating a request for money. Each of the 5 C's represents a different component of the decision process and analyzing and taking action of the loan request. Those 5 C's are character, capacity, capital, conditions, and collateral. To start off, we'll go into character. Every lending decision requires the answer to the basic question, is the customer of sound character and do they have the management ability to run the operation and repay the loan? The character factor is often regarded as the most important credit factor because it's the catalyst that transforms expectations, goals, projections into realities. Therefore, it's imperative that we collect the most accurate information and perform the best possible analysis on the credit factor before making a lending decision. As in the other credit factors, we can't just look at character and rely on it only. We have to look at a balanced view of all the factors of the 5 C's of credit. For the purpose of the lending decision, character we define as the customer's willingness and determination to repay the loan regardless of any unforeseen adversity. Character includes qualities such as honesty, openness, integrity, and self-discipline. In general, sound character should be viewed as a necessity, but not the only condition for acceptable loan performance. We have a quote that we tend to lean to, and I personally enjoy and thought it was relevant to this discussion, and it is, people with good intentions make promises, but people with good character keep them. And then the next C that we want to go over, so we've gone over character, we want to go into the next one, which is capacity. Capacity refers to the customer's ability to generate sufficient earnings to repay their obligations. Again, we're going to go into more detail in the following presentations as to some of these terms that we'll be using in this section. These obligations include items such as current obligations, so what's due within a year's time, repay any new debts. If you're taking out a new loan, do you guys have the capacity to be able to repay the payment on that new debt? Plus provide an adequate margin for family living. Do you guys have enough to support your everyday life? And then also, do you have the ability to keep some aside for savings for a rainy day? Earnings capacity is not the same as cash flow. As lenders, we use accrual adjustments. These adjustments must be made to cash income records to accurately determine net income or earned net worth change. An operation can have sufficient cash flow to meet current obligations without having positive net earnings. But the reverse can also be true. The first use of this net income is to cover your withdrawals for your family living. The remainder is used to repay your capital debts or to buy other new assets. Income not necessary for these purposes is available to expand, invest, or build a reserve. So basically, the remainder is you can use it to expand your operation, buy more cows, buy more land, or even just save for that rainy day again. What we do when we analyze the repayment capacity, we examine both your historical and your projected cash flows and income statements and earned net worth changes. We want to make sure that we're looking at the whole operation and not just today if you're going to purchase 50 more head of cows or if you're going to be running more ground. We want to include that additional income that will come from that asset. Over the long term, repayment capacity margin must be sufficient to cover the occasional operating losses and unforeseen expenditures, whether that be commodity prices or even something such as a hailstorm that comes through and destroys a crop. Were you able to save that positive margin that you generated previous years to be able to cover some of these operating losses? The risk associated with the capacity factor is closely associated with the capital factor. We'll discuss capital here in a second, as it's the third C. But as the risk of low or negative capacity margin increases, the correspondingly stronger capital position is required to ensure that sufficient repayment reserves are available should there be some sort of earnings shortfall that year. Moving on to capital. Capital refers to the customer's financial position and is typically reflected on an individual or entity's balance sheet. Capital is the third C of the 5 C's of credit that we look at as lenders. An evaluation of the capital position typically involves an analysis of the financial progress, asset quality, working capital, the liquidity of the operation, solvency, and your debt structure. We want to make sure that all of these items that we look at are in the best interest of the borrower. The analysis of these factors involves historical and current balance sheets, together with income statements of even dates, such that the cash to accrual and changes in the net worth can be evaluated. We typically, again, as I said before, we like to get current balance sheets, but we also like to look at the historical ones, and we like to compare them with the income statements for the prior year as well. We like to see what changes have been made in the operation from year to year. Part of the analysis of capital is determining if the customer's financial position has improved or deteriorated over time. Whether considering past, present, or projected financial statements, the lender examines the value of these statements relative to the customer's previous position. One of the items that we like to look at when we're looking over a customer's capital is the liquidity of the operation. We want to see current assets that can be easily converted to cash, as they are important sources of reserves to ensure that loans can be repaid on time. There's a lot of different formulas that we can use to describe a liquidity position. The most common that we typically use is working capital and a current ratio. And again, we'll go into more detail on these as the presentations continue. But as a brief overview, working capital basically is your current assets minus your current liabilities. What can be converted into cash in a year's time versus what needs to be paid in a year's time. The next one is the current ratio. It's very similar. Current assets divided by your current liabilities. And what this tells us is how many current assets do you have compared to your current liabilities. For example, a current ratio of 2-to-1 indicates the value of your current assets could decline by 50% before your liabilities would exceed your liquid assets. A current ratio of 1-to-1 or less indicates the potential for a serious liquidity problem. And again, we'll show you some examples of these going forward and where they come up on a balance sheet. One of the other items that we look at is solvency. It's one of the most important risk measurement tools that we as lenders have. We look at 3 different things, 3 measures of the solvency that document the relationship between your total assets, total liabilities, and the customer's owner equity are as follows. Your debt to equity ratio. Basically what this is your total liabilities over your owner equity, also known as a leverage ratio. Debt to equity ratio of less than 1-to-1 means that the customer's own capital exceeds the amount of the debt capital in a business. A value greater than 1-to-1 means the creditors have a greater claim of the business than does the producer. So basically a 1-to-1 means the lender owns more of the operation than the producer himself. Another part of solvency is your debt to asset ratio. A debt to asset ratio of over 50% means creditors have a greater claim on the business than the producer. Consequently, as the leverage ratio or debt to asset ratio increases, the solvency decreases. The final one that we like to look at is the owner equity ratio. What this is your total assets divided by your total liability. An owner's equity ratio of greater than 50% means the producer, rather than the creditor, owns a bigger share of the business. This ratio is a direct inverse to the previously stated debt to asset ratio. Moving on, and And again, we're going to go into more detail on capacity and capital later on in these presentations. The fourth C is conditions. Conditions refer to a term and conditions under which the loan is being approved. We as lenders have direct control over the provisions, such as the loan amount, use of funds, and loan terms. We are responsible to make the amount and purpose of the loan constructive and establish repayment terms that are practical for all parties involved. The primary purpose of a loan is to improve the income and financial position of an applicant. Conditions should support our analysis recommendation for the loan after analysis of all other credit factors. The amount must be adequate to serve the applicant's needs, yet be reasonable in relation to the supporting management skills, repayment performance, financial responsibility, and collateral. The loan term should not generally exceed the economic life of a project or the asset being financed. We don't want to make a 30-year loan on a cow because typically the cow's life is not going to be 30 years. Approval requirements and structure. Some of the loan agreements, personal liability, additional collateral, margin considerations, and insurance should assure adequate repayment performance and collateral safety without disrupting you guys' normal operation or your business. We don't want to be a burden when we're putting these conditions on. As part of conditions, I think it's important that we discuss necessities, needs, and wants to the operation. Your necessities basically are the essential requirements of the operation. These must be provided for before credit is extended for any other purpose. Wants are those things that we can get along without. They don't directly contribute to the profitability of your business. In fact, the operation may falter and the loan may deteriorate if excessive credit is provided for wants. And doing so might preclude the extension of additional funds to meet necessities as they arise. The last of the 5 C's of credit is collateral. Collateral is an asset that's being pledged to the lender to ensure performance of the lending agreement. In some lending relationships, the collateral is basically the primary source of repayment for the loan. However, here at Western AgCredit, collateral is the last line of defense for the lender to avoid taking a loss on the loan. Some of the types of collateral, there's personal property, and again, we're going to go over later in these presentations as to what types of collateral secure what types of loans. The first type of collateral is a personal property type. Personal property is typically described as any tangible, movable, or immovable property other than real estate. This form of collateral is normally used with our short-term financing. The next is real estate. This is physical land and the structures on the land. This form of collateral is generally associated with our long-term financing, but we can use it for short-term loans as well. And the final is real property. Basically what this is all interests, benefits, and rights inherent to the ownership of the physical real estate. Short-term and intermediate loans are primarily secured with a first priority interest on personal property. These loans may also be secured with a first priority interest in real property. As the loan term increases, generally the need for security also increases. On long-term notes, primary security must consist of a first lien or an equivalent interest in real estate. This concludes the presentation of the 5 C's of credit. And again, I did go over some of these items fast and I didn't give a lot of detail. However, the following presentations will go into more detail of the 5 C's. If you have any questions, feel free to stop in at your local branch or give us a call. And we'd be more than happy to help you with what questions you may have in your financing needs.